Chase, you ready for another company?
Let's do it.
Are we doing Workday?
Workday.
Workday. All right, let's do Workday. Their symbol is WDAY, Software Application Industry. About 5% short on the float. Nothing to be concerned with there. PE ratio 108.7 versus 52.2 for the industry, so a high PE industry. Price to sales 7 versus 6.8. Price to book value 6.8 versus 7.1. Price to cash flow is 24.3. That is better than the industry at 31.7. They got a good pay ratio, 1 versus 8.3. So that's the only positive I've seen so far. Now, I don't know what happened here, but over the last year, their earnings fell by 63%. The industry was up 5.5%. The sales last year were up 13.9%. Industry was only up 4.7%. And the 5-year earnings per share growth estimate for the analyst is 26.4 for the company versus 8.2 for the industry. So that's a positive there. Workday does not pay a dividend. Look at the balance sheet. Current ratio is strong, 2.1 versus 1.7. Debt to equity, 0.4 versus 0.5, so no problem with the debt there. Net profit margin is 6.5%. That is half the industry at 12.6. We do see return on equity is 6.4 versus 19. Free cash flow does look pretty good, $2.3 billion versus about $2.8 billion for the industry. Not too many things I like in this company, a couple of good things, but maybe got some good growth going forward.
I was kind of looking at the company, and they are in the enterprise cloud applications business is what they do. It looks like they offer a suite of financial management applications. Looks like some maybe HR tools, kind of cost management, things of that nature. Again, in the cloud. So that was kind of the hype several years ago. But I thought this was interesting. I didn't know this. I have heard the name Workday before. But the company was formerly known as North Tahoe Power Tools, Inc.
What?
This was Seeking Alpha was telling me, so I'm going to go with it. But I was like, what? And I guess they changed its name to Workday in 2005. So this company has been around for several days or several years. And I think they're the ones that, like, they have the Rockstar commercials on TV.
Oh, where Billy Idol and
and
Kiss, I think those guys.
Yeah.
Crazy commercials.
Play like the air guitar, and I think they're funny. I mean, gosh, the first time I saw one of those commercials, I was cracking up. So kudos to their marketing department. I don't think we could use Workday.
No.
Great marketing. But looking at the business here for Workday, current price, again, their ticker symbol WDAY, WDAY, essentially $233.62. 52-week range, the low here is $205.33 and the high $294. Kind of, again, talking about the hype of, the cloud. And
right.
Are we going to see the same thing with AI? I think so. But if you look at the 10-year return for Workday, it's like 221%.
That's pretty good.
But the 5-year return is just 15%.
Oh.
So all of that essentially came in the first 5 years of the 10-year period. And I think this is what's going to happen with a lot of these AI companies, 10 years from now essentially or 5 years from now, a lot of that return is going to come from the first 5 years, and then it's going to kind of peter out.
Chase, I'm so glad you bring that up because people, they've got to really understand numbers. Because as you say, 10-year return's been great, but it's been terrible for the 5-year. And if you're just buying stuff based on the 10-year return thing, this is going to be a great investment, you could be missing the boat and have terrible returns the next 5 years.
Yeah, you miss your shot, essentially.
Yeah.
So, but yeah, I think that happened with a lot of the cloud companies, a lot of these software companies. That was all the rage, and then AI kind of took over. But we'll have to see if that shift does occur yet again with AI in the next cycle. But with Workday, the thing that kind of prompted this was the management firm Elliott, the activist firm Elliott. We talked about them, I think, last week about PepsiCo. Gosh, they must have had a ton of cash.
Where do they get these billions of dollars that they have?
They took a $2 billion stake in Workday just recently, and you're like, didn't they just take a $5 billion stake or something like that in PepsiCo? I don't remember the exact number from last week, but I'm like, wow. And I guess Elliott, what they said is they're pleased with the dialogue with the team and believe the plan announced at the Financial Analyst Day represents a significant enhancement of Workday's operating model and capital allocation framework. We believe this multi-year plan will drive substantial long-term value creation for Workday shareholders, and we look forward to continued collaboration with the company. The thing that I find interesting with this is I thought a lot of times Elliott was more of an activist.
Right.
Are they kind of more being passive with Workday? Yeah, we like how they're doing things. I thought that was kind of strange.
It does kind of sound that way, and I thought they would put people on the board and do ideas. And didn't they also try with Southwest Airlines and they backed out? Was it Elliott that did that?
I don't remember if it was Elliott or a different activist firm.
Okay, yeah. But I mean, activist means you're going to do some activity. not just sit there and
Yeah.
buy the stock. But yeah, maybe they're sitting on a lot of cash. I know that's been a problem for a lot of investment companies, sitting on a lot of cash, and we are as well. But we're not quite ready to start employing some of that. But I think we maybe next month we'll start doing something. But I do see for Workday that the earnings are up about 3% the estimate over the last 90 days. So it appears to be looking better.
Yeah, I mean, this business is growing. Again, that's
Yeah.
not the problem with a lot of these companies, but the overvaluation that occurred was the issue. I mean, because if you go out to January 2027, the estimated earnings per share that I have is $10.49. Gives us a target sell price of $174.13. I mean, that's still a multiple of 22 times. And I'm not advocating for investing in this company, but you're getting earnings growth this year of 22%, next year about 18%. I mean, you are getting substantial earnings growth, so you can warrant a valuation above our target of, I'm going to say 16, 17 times. It's not how I do things, but I can almost kind of see the case of why you'd want to invest in Workday. The PEG ratio looks decent, but it's again just something that doesn't fit our value investing philosophy.
And people say, gee, they miss some companies doing that. But the reason why we don't like growth companies is that the decline can be very high when it comes. I mean, you can have a decline in the stock of 30, 40, maybe 50% very easily. If you have a more low valuation company, that decline will probably not be 50%, could be only be 10, maybe 20%. So it's a little bit easier to handle that. When you lose 40% on a company, you're probably going to panic and sell out.
Well, I mean, the reason it can be a problem, right, is you're paying, again, I'm going to say, 22, 23 times for the future earnings, but you're looking for about 20% earnings growth. It just takes one little problem for that earnings growth no longer to be 20%. So now that earnings growth falls to maybe 5%. You're like, yeah, well, the company's still growing. It's like, well, now that forward PE went from, maybe 23 up all the way to 30. Well, I don't want to pay 30 times for a company that's growing earnings at 5%. When you buy growth investments, that's the big problem. If they miss on earnings growth, that's where that stock can falter, and that's why I don't like to take that risk.
Yeah, and I saw the other day too, and we talked, I think, last month about how the margin debt is now $1 trillion. I saw it now reached 1.1 trillion. So it keeps going up and up, and it's just something that worries me because if you margin this company and it dropped 20%, you might say, well, I'm just going to sell and get out. And that starts the avalanche downward. So